Hello and welcome. You're watching Trending Tech on NewsX World, where we bring you the latest tech breakthroughs and trends from around the world. Financial markets are evolving faster than ever, driven by AI, automation and high-frequency trading. Bitcoin and Ethereum EFTs are bringing crypto into the mainstream, attracting billions from institutional investors. But questions remain. Is it a legitimate asset or just speculation? Machines now make most major trading decisions, executing thousands of trades per second, shaping prices in ways humans can't. Liquidity providers and market-neutral strategies promise stability, yet flash crashes and volatility persist. Regulators are racing to build and keep up, but innovation moves faster as AI and quantum tech reshape finance. Viewers ask, who really controls the markets? People, algorithms, or power? To talk about this, and joining us now is Josh Bubar, the managing partner and COO of Velox Trading Group, where he is shaping the future of digital asset investing and high-frequency trading. Under his leadership, Velox Trading has become a top-performing quantitative investment firm and liquidity provider in crypto, managing one of the world's leading market-neutral digital asset funds. Josh has built and scaled over 40 ETFs, hedge funds and crypto products, including launching the world's first Ethereum and Bitcoin ETFs. He is recognized globally for his expertise in systemic strategies and quantitative finance, driving innovation in both traditional and digital markets. Thank you, Mr. Bubar, for joining us here on Trending Tech. It's a pleasure to have you. Right, my first question to you is from Bitcoin ETFs to AI-driven trading financial markets. They're now faster, more automated, and more complex than ever. Yet most everyday investors still don't understand how these systems really work. Are modern financial markets becoming smarter or just more dangerous?
Yeah, sure. So from the investor's side, I think what's really important for them instead to consider is buying and selling. How simple can they go and transact on the current market value they see on the screen? So although that's true, financial markets might be becoming more complex as time goes on, really they're becoming more liquid and significantly more competition. In reality, it's good for everyone. So I would say less about are they becoming more dangerous and more is complexity creating more competition. Markets being more competitive is good for all investors. So really, they want to be able to buy and sell and express a view of what they see on screen at the price they're seeing. I think those factors, such as new investment products on top of automated systems, I think that creates a more natural flow into the market making things significantly simpler for investors to buy and sell today.
And of course, with Bitcoin and Ethereum, ETFs now approved and attracting billions in institutional money, crypto has moved from the fringe into the financial mainstream. Has crypto finally matured into a legitimate asset class, or is it still built on speculation?
Yeah, the crypto markets are interesting. I mean, I've been involved in them in over a decade. There's always speculation on, are they legitimate? Is it an asset class? Is it not? I think if in terms of what defines legitimacy as adoption and market activity, I mean, over a $3 trillion market cap of the asset class in US dollars, along with 2 to 3 trillion of open interest in the derivatives market. You have multiple large institutional players, even GSIB banks that are now entering the space to participate not only in trading, but around tokenization, stable coins, real world assets. I think we're at the point of well past speculation to this extent, and maybe not into maturity, but more into global understanding and adoption.
Now, HFT firms execute thousands of trades per second, shaping prices faster than any human trader ever could. Does high-frequency trading make markets more efficient, or does it give an unfair advantage to those with the fastest machines?
I think that will really depend on who you decide to ask. For larger players, as far as they're concerned, they'll get adverse pricing on much larger orders. That tends to be who usually is really wondering, hey, am I going to get a really poor trade for my client? And that's really important to them. They can happen though, however, a lot of these larger market orders, instead of fighting against the HFTs that are doing significant amount of trading, it actually benefits them. They're using that technology in order to execute trades on a more orderly manner, cheaper for their clients, which ultimately is the entire antithesis of why a market is there. You want to have a really good fill where a buyer meets a seller. For the retail, it's definitely a net benefit in my view. More activity in the market makes trading significantly more efficient for the retail because there's significantly more competition to compete for that order. They end up benefiting at scale in all this competition, even if there's a lot of negativity in the media and the press against them. So on the whole, I would see it as a net benefit to investors.
And market neutral strategies aim to make money whether markets rise or fall, even during crises. In an age of global uncertainty, is risk-free investing realistic or just smart marketing?
Well, in terms of risk-free, look, there's really no free lunch. There is risk involved, even in very risk-adverse instruments. There's risk everywhere. That's how you make a profit. Market neutral strategies are no exception to that rule. So for strategies such as like ours, what we focus on, software and counterparty risk as opposed to price risk are really the risk you're trading off and that benefit. So a lot of investors prefer that because they already have a lot of market risk. So even true, I guess, risk-free instruments, we would call them, such as U.S. Treasury bills, although it's an extremely small risk, there is still some risk embedded in the back end of an economy, in this case, the U.S. economy. So I would say with more global uncertainty persisting, a lot of these instruments may have relatively a higher risk than they did before, but realistically, true risk-free investments are very, very low. Market neutral strategies, though, instead, they're really focused on swapping a different set of risks for another set of risks. So not taking market risk and price risk, but instead focused on taking software risk and counterparty risk.
And liquidity providers are supposed to stabilize markets, yet flash crashes still happen in both crypto and traditional finance. Are liquidity providers protecting markets or profiting from volatility?
Yeah, liquidity providers, look, they're there until they're not. Generally speaking, they're going to be there at almost all times, but flash crashes, I think, are negatively blamed a lot of the times on liquidity providers. Realistically, that can happen for a very wide factor of reasons. Sometimes these are connected to them, sometimes they're completely unrelated reasons, such as market structure design. I think the real question is, do they contribute to the flash crashes and volatility more than they don't? If so, I would say probably no. However, they're certainly by design going to profit off of the volatility because volatility enhances volume, which enhances mispricings, which is really the main focus of their business, is to profit off of the orders, but they want more people to cross the spread. So at the margin, I think they're probably more of a net benefit than a net adversary in that case, but they're certainly in volatile situations. They're going to profit off of those opportunities. The real question is whether are they contributing to the creation or not.
And governments are racing to regulate crypto while firms are racing to out-innovate regulation. Does regulation protect investors or slow down financial progress?
Yeah, in my view, look, responsible regulation is a good thing. I think at scale, most different economies and jurisdictions are looking to see crypto more regulated. What's going to happen is more regulation makes easier participation. More participation in the industry is what everyone in crypto really is looking for. They want more people to use the products. But that said, crypto is also very, very unique, where capital is incredibly mobile. And moving money into new products, regardless of their geography, is really only a few clicks away. So especially in decentralized finance where there's no borders, regulation is going to be really tough around that. So it's going to have a difficult time to slow those users down if they want to go and use other products. So do I think it's good? Yes, I think it's great. Do I think it's going to try to slow things down? Yes. However, I think it's going to be very difficult for the most innovative areas of crypto.
And most major trading decisions today are made by algorithms, not people. Should machines be trusted with the world's money?
Well, I would say the machines still have humans that have made and created the decision parameters. So there's still people behind how those trades are occurring, although they're getting executed based on a preset conditions and orders that someone has designed. I think that really changes when trading starts to occur with no human input whatsoever. And I'm sure that's going to happen to a degree. I'm sure that happens somewhat today. I just don't think we're there as of yet. That's a question to definitely revisit in 4 or 5 years when a lot of large language models are now powering trades completely autonomously. For the time being, most of the trading is still occurring with a human-based input. So I think that question is not yet to be determined.
And AI, automation and quantum computing are set to reshape finance once again. Will future markets be more fair or more opaque?
I think if technology is going to enable more people to participate with less friction, that's always going to be a net positive. It's a marketplace. This is what makes markets great. We want more people to participate in the market. That's a net benefit for everybody. I think the real question is when these people are trading, if it's recognized within the order book, meaning everyone can see that they're trading all in the same venue in the same place, or is it going to be elsewhere? If all of the AI, if all of quantum computing, if automation reshapes finance that everyone still sees what everyone else is trading and not looking at your order in a negative way, but more everyone comes to the same venue, the same marketplace to participate, I think that's going to make things actually more transparent. It's going to make things actually more fair. If it's going to be off of exchanges in different markets we call dark markets, I think that could change the quantum a fair amount, and then that's the real question to be had.
And finally, finance, of course, now runs at machine speed, global scale and enormous influence. Who really controls the future of the financial system? People, algorithms, or power?
Yeah, that's a great question. I think today, ultimately, humans still control the machines, the inputs to the machines that are trading. And a marketplace is still, if you think about it, a group of people expressing a view on a company, a commodity, a contract, a cryptocurrency. Down the road, if that changes and machines are now making the decision, again, in the world of large language models, if they're making decisions completely on their own, I'm sure that's going to happen. Algorithms are then going to be a much more critical player in the financial system. Personally, I'm really excited to see how that's going to potentially change the market. But today, I think there's still a lot of human input and design that goes into the decisions being made. I think that's going to dramatically change in 5 years. And again, quite excited to see how that's going to look.
Thank you very much, Mr. Josh Bubar, for joining us on this episode of Trending Tech and sharing your insights. But with that, it is a wrap on this episode. For more tech updates and innovations, stay tuned on NewsX World.